Welcome back to my channel. Today we're going to review GMX. For those who are unfamiliar with my channel, what I do is I do research. I feed that research into a model. The model has an output and I weigh that output to reality, and then I reflect and modify the model to better correlate to higher ROI in the cryptocurrency space. This is my model. The project is GMX. I'm going to dive right into it. So GMX is a perpetual exchange on Arbitrum and Avalanche. Arbitrum is a scaling solution for the Ethereum computer. Avalanche is another L1, a trust computer. You have to look at my other videos if you want to know what that is. So basically a scaling solution. This allows for Ethereum to operate more effectively, or at least with lower fees. It offloads transactions, it bundles them, and it's a bunch of bundling of transactions off chain together into one transaction on Ethereum to be cheaper. And this one's just another trust computer. But I'm not going to dive too much in that. Perpetual exchange is what I'm going to go into really here. And that is the service provided by GMX. And they can have more services in the future. So we're just going to go through a simple example of what that really is. So it's basically in the normal stock market, there is the ability to have options contracts with expiration dates. Perpetual means that you don't have expiration dates. You just kind of rent the tokens for indefinite periods of time as long as you can keep making those rent payments and as long as you don't get liquidated. So that's what a perpetual exchange is. It's, allows for in perpetuity, right? So now I'm going to do an example here, and this is just for people who are unfamiliar with leverage so they can get an idea of what this service provided is. So we have these two parties here. A lender and a borrower. So why would a lender want to lend their tokens to someone to short or long, right? They do it because the person who borrows the tokens is renting them. They pay a fee for borrowing those tokens. And so that's why this person, they might say, oh, I know that there's someone that's going to use my tokens to bet against me. But I don't care because I think this project's going to go up and he's going to pay me some rent, some amount for borrowing my tokens, selling them on the market, and taking a position against me. I'm fine with that because there is a little bit of risk, but I think that I'm going to come out with a profit from the rent plus whatever the risk is. And the risk is liquidity, etc., but I'm not going to dive too much into that. All right, so you have this lender and you have this borrower. Now, in our example, we're going to have three tokens. We're going to have token A, token B, and token C. Token A and B are one-to-one at the market rate for those two tokens, and A and C are one-to-one as well. We're making things super easy by making all these prices the same. The borrower has 50 C tokens, so that is equal to 50 A tokens because it's one-to-one the price, right? So this person says, I want to take a 2x leverage on my collateral. I put up my collateral as risk. That collateral will completely disappear if I am liquidated. That's what that means. So that person says, okay, so I'm going to take 2x leverage. It means I want twice as much exposure to the price action of against A because he's going to take a short against A. So what he does is he borrows A. He borrows 100A against his 50C, which is equal to 50A. So he's pretty much doubled his exposure. He sells it on the market, and he gets 50B tokens, right? And 50B is what 50B is what he's going to long, because he's holding it. He's shorting A in relationship to B. B is the one he's holding, so that's when he thinks it's going to do well. And now I'm going to make, in our example, I'm going to make the price move against him. Now, here's one thing you need to know in any of these contracts that makes it pretty simple. Whatever the person holds, whatever they're holding, and whatever their collateral is, so whatever they are holding. Like if this person didn't sell the token A, then nothing would have happened, right? If as long as C stayed the same and as long as B stayed the same, everything stayed the same. Nothing would happen if he didn't sell it. He just borrowed it, except he would have been out the rent. But because he sold it on the market, that's him taking that position. So this person, whatever they are holding in their hands from this leverage position, which is the 100B, plus their collateral, when those two values equal the amount owed is when you're gonna get liquidated because you have to pay back the lender. So that's the liquidation price, right? So in this case, the liquidation price would be if it went down 50% because it's a 2x leverage. So that's what I did. A and B, so now A can buy 2B because B went down 50% against A. But A and C stays the same. Now, there's other complexities here. I'm not going to go into it. This is all just a general example to make it super easy. So what happens is this situation happens. The market went against our borrower. So now 100B plus 100C is equal to 100A. So he's got to pay back the lender. So he sells his 50C and his 100B that he bought, which he made up here. It used to be, this 100B used to be worth 100A, but now it's only worth 50A. So, and this is still worth 50A, his collateral. So they together, they equal the amount owed. So he takes it, he sells it on the market, he gets 100A back and gives it back to the lender. The lender walking away with the rent. And whatever risk there was, if there was no liquidity, he would have may or may not benefited. But in many cases, he does, and that's why he does it. So that's a super general example of leverage, and that is the service provided by GMX. So you can see there's a lot of trading here, and there's a potential for a lot of fees because a lot of people want to do this because people don't like getting one-to-one exposure. They want to have 100x exposure or what a 50x exposure, 30x. So they want to be crazy. Oh, I want to take $100 and turn it into $1 million. So I'm going to put it on 100x, right? And you put your 100x on it, $100 on 100x, and you have what? You have 100 plus 100x exposure. So now you're exposed to 10,000 in price action. But if the market moves 1% against you, you're liquidated, right? That's why 100x is kind of crazy. But if it goes for you 1% or 2% or whatever, you could be double your money on 1%. 2% is tripling your money, So that's why people want to do leverage. Now, this is the back end a little bit of, there's another token involved with GMX, and that is the GLP token. It's somewhat of an index exposure. It's kind of an index. But it's an index of Ethereum tokens or whatever tokens they choose to put into this pool. So basically, as I said before, there's a lender and a borrower. Well, GMX takes that position automatically. It could be equally matched up, or it could just be the pool itself is taking that position, this pool of assets. And this pool of assets exists with the GLP token. So as people add to this pool, or as they take trades against it, they're adding to this pool, which allows for people to take these positions. And that's why this GLP is a pool share. It is minted from adding to the pool. The GLP price is the token assets in the pool plus the trades, right? Or the positions that are open. So you can see there could be more longers, more shorters, but the protocol itself is in essence taking the opposite of the other position because it's getting exposure to the opposite position of whatever people are taking. And the idea here is that there's fees for this service provided of this pool, and the pool should come out ahead because most traders are at a 50-50 odds, and this thing takes in fees, so the pool should grow, right? And that's the way it should grow in size. Now here's the risks of this service provided. There's smart contract risks, that something goes wrong with the protocol. There's counterparty pool risk. There's a chance that someone wins the entire pool and wipes it out, making this go to zero. So there is that risk. If someone wipes out the pool because they take a huge bet and they win, like let's say they take, like the protocol itself is the counter bet for many of these bettors, so to speak. And if someone wins that bet, then they can wipe out the pool. So that is a risk, but obviously this is a huge amount, so that risk is relatively low. And also there's plenty of people who take the opposite side of that trade, and those people are that is what that person's betting against, not the protocol. So whatever the difference is what the protocol risk is. And if that suddenly shifts, there's probably math models to do this, but I don't want to get too deep into that. All right. And then there's the token peg risk, which is the Oracle feeds or something like that goes wrong. So that's kind of like on smart contract levels as well. Okay, so I kind of went too much into it, but that's basically what GMX does. That's the service provided and for those who are interested. Now I'm going to dive into the token price and whether or not my model expects the token to perform. So the model expects the token to perform. Put this over here. The token expects future increase in demand for the token. Price FOMO is expected. Now, the roadmap hasn't been updated in a while, so that is a neutral reading. Now, regarding weak hands, these metrics are normally weak metrics, right? But there's some other things that I want to say. Like, it's got hot social media, so this means that social media has been growing for this project. And that means that this project is kind of, a lot of people are aware of it, and it's growing in popularity quite quickly, and those are kind of risky things. The holders composition is the holders' composition is that 70% of the tokens are held for 1 year and 30% are held for 1 month. So that's the general holders right there. The holders making money at the current price, basically everybody's in the money because this thing's making all-time new highs right now. So it's got a general risk from weak hands because, but I think that these metrics aren't that heavy on this in this particular case. That's why I rated them as neutral. All right, so now these are kind of general token supply distributions, et cetera, but I don't think they're important metrics. They're green because this token is a P/E token, price to earnings. You are entitled to earnings across the platform from holding the GMX token. We're talking about the GMX token. We're not talking about GLP. GLP is a different token. It is entitled to fees, and it has its own gross metrics based on what I just explained about how that one works. But we're talking about the GMX token here. And that one is entitled to the revenues that move across the platform. So GMX gets fees for the fees from the services go to the GMX holders. It is also DAO vote, so it's control over the platform. It receives 30% of those fees as a dividend, and liquidity is owned by the protocol, and it grows from the fees. So that the token is well entitled to the future growth. So it's like a P/E, price to earnings of the platform. So it really doesn't matter how the tokens are distributed. If they were 99% held by one person, it doesn't really matter as long as the protocol remains open and running and the service provided is not going to be hacked or anything like that. The distribution is irrelevant. It's like a regular company in that sense. So, and also there's no worry here from ICOs dumping. Even if they did have the token, it wouldn't, like I said, because it has a good PDE, that means that it's not super risky from ICO dumpage. So recent price actions are relevant because we're talking about PDEs now, and we're at a 2.36 PDE, which is a good one, healthy, especially in crypto. Many of them are usually overvalued. This one's actually undervalued from a price to earnings perspective. So that is the basis of why these token metrics are all in the green, because it's like from a general point of view. But there obviously are risks that I'll go over in the future. So normally it's not a small market cap, but once again the PDE overrides these things. Okay, so exponential growth. So this thing has made growth of market cap to total value locked funds in the platform. It has grown in market cap by 4x over this period of time. Over this period of time, like about a year or something like that, and the actual total value locked has grown 16-fold. So we're missing a 4x here that should have been realized in the price, and I think that the fear in the crypto markets is partially why this price might be doing this. So that's why these metrics for exponential growth look good, and so it looks like it's good there. All right, so now here's the negative aspects. It is an anonymous team with the governance is really just loose voting, and who's in control of the GitHub repository that controls this, the smart contracts that control this, is basically the anonymous team. So that is a risk factor. Now that the code is open, it's got audited by ABDK Consulting, and that is the same group that has been hired by Uniswap, or one of the groups that has been hired by Uniswap. The anonymous team made XVIX, that is part of their history, and Gambit. So these are kind of things that lend to their credibility. You could even see the review on GitHub of where the audit is of their code. But I put everything else as risky because it is an anonymous team. So you got to be worried that there's a potential that they go, hey, I'm bored with this, and they move on, because there's no credibility there from that standpoint. But they're obviously their code is open sourced, so it can be reviewed, and people can see that they know what they're doing. All right, now fees that burn in tokens. There is fees that burn in tokens, so that is a good thing that's like a dividend once again. Now the value of the target market for this is trading crypto will grow. The world's assets are going to move on chain, and there's $10 trillion in assets for this kind of service of trading assets. So it's got a large market opportunity, even with a market cap of, what are we at? For about 500 million. Okay, so 500 million, and it's got a 10 trillion or more addressable market, so it's relatively small. or even bigger, like you got to multiply by 20. That's like a single one-to-one PD, etc. All right, so that's the summary of the project from the model rundown. Pros and cons. So the pros, great PDE numbers, great growth models, code open to be reviewed, so you can open source it and see what code has been written. Skilled developers and leader in the perpetually DEX space. So this is the leader that I know of. The cons, updates, the roadmap hasn't been updated in a while. Hot on social media, so it's super hyped right now. But, that's because people are finally leaving centralized exchanges. Anonymous team, which means control of the code, releases, as far as I know, is controlled by this anonymous team that controls the Git repository. I may be wrong about that. There might be nodes that operate this thing, but I couldn't find any information on that. I was trying to look all over the place to see if this thing was a decentralized node operating system, but it looks like it's just smart contracts that are controlled through a Git repository or some kind of repository on Ethereum, and that is voted through a community, but they can really do what they want because whoever's in control of their repository is in control of the code. So that's what I kind of saw there. And it, so you kind of trust the team. So, but that's the extent of my knowledge. I might be wrong on that. But that is it. That is the summary. I'm going to go into my Patreon exclusive content now of what I personally am going to do and my personal thoughts on my own portfolio. If you like this kind of content, please like and subscribe. And this was a rundown of GMX through my model. All right, later, guys.